Hey, how are you? I'm Duncan McPherson, and welcome back to my channel. Today is the fourth of my four-part series on how Canada antagonizes, tortures, and interrogates non-residents that own, rent, and sell Canadian real property. So once again, listen up on how to reduce your pain without a doctor's script. And if you haven't watched parts 1, 2, and 3 of this series, make sure you do, because there's a lot of information that pertains to you as a non-resident of the Great White North. And for more information on non-resident compliance, check me out at themactax.com. And don't forget to subscribe for more tips on navigating the Canadian tax system to avoid all the bull probably already experiencing. Okay, so now it's time for you to reap the rewards of your investment and sell your property. And that's what this video is about. I am going to walk you through the 3-step tax process of selling your Canadian real estate. Now, I am assuming, since you've been renting, you have a Canadian tax ID number. If you don't, you're probably in big trouble. So please call me. You can get my number at themactax.com and it'll put you through to me directly. No middlemen. Okay, I had a client up here who was renting out Canadian real estate for 6 years. He was an American. He was told by his U.S. accountant that since he was reporting the rental income on his U.S. 1040, he wasn't required to report it in Canada. I'm not sure where he got that from. The client's zip code was 90210, so he didn't get a lot of sympathy from CRA. Not sure what his accountant's zip code was, probably 20500. FYI, that's the White House. I was able to salvage the situation, but not without a lot of phone calls and a lot of Tylenol. So take it from me, you want to do exactly what I outline in this video. It will save you headaches beyond belief. Okay? Okay, good. It's time to sell. Step 1 is preparing your T2062. The law is up here in Canada that you must inform CRA within 10 days of the property closing that you have sold Canadian real estate. And I have mentioned in my previous 2 videos, the law is an absolute joke here. Do not wait till after you sell the property to inform CRA. As soon as you have an accepted offer on your Canadian rental property, please inform CRA right away. This is done with Form T2062. If you are late notifying CRA, the penalty is $25 a day, up to a maximum of $2,500. But I absolutely guarantee you that $2,500 penalty is going to be the least of your worries if you wait to inform CRA of the pending sale. Please contact them as soon as you have an accepted offer. You notify CRA of the pending offer using Form T2062. You can submit Form T2062 online, and if you have your ID number, which you have to have, it's really easy to do so. Also, with Form T2062, you must send in the purchase and sale agreement from when you purchased the property. But you're okay here because you listened to my previous video and you have this purchase and sale agreement sitting safely in your safety deposit box, right? Right on. So now let's go to step 2. Step 2 is preparing your Form T2062A. If you took depreciation on the property up here, which you almost assuredly did, being an American, won't get into why that is, but you almost assuredly did. Once you have taken depreciation on a rental property in Canada, you must also prepare Form T2062A. You're doing this to report the recapture and ergo calculate the withholding tax on the recapture from the sale of the property. Now, there's a list of information you must attach to the T2062A. So pay attention or just write this down and check it off as you go. The list of information includes, but is not limited to, number 1, the depreciation schedule from the date that you own the property. Number 2, again, the purchase and sale agreement from when you purchase the property. And number 3, the backup or the valuation to show the split between land and building at the time you purchased the property. But of course, 2 and 3 are not a problem for us because you've listened to my previous videos, and 2 and 3 are sitting safely and soundly in your safety deposit box. Good job. Also, and this is very important, T2062 and T2062A must be submitted together. And again, they can be submitted quite easily online. And again, it's even less difficult if I'm the person representing you. After CRA processes these forms, they will send a certificate to the purchaser's lawyer, authorizing him to withhold 25% of the recapture and 25% of the gain, not the gross. The actual amount of the withholding will be specified in the certificate. And if you're wondering if the sale price changes between the date the certificate is issued and the date it sells, it's okay. There's a provision in the law for that. Don't worry about it for now. And in step 3, I will give you more details on what CRA means by the gain. But for now, let me be extra clear on something. If you have your paperwork in order, and as soon as you have an accepted offer, you file the T2062 and T2062A, the process runs quite smoothly up here. It is just a lot of admin. But again, if you follow my advice in these 4 videos, even the paperwork isn't that bad. But don't say I didn't warn you if things go off the rails because you didn't follow my advice in these 4 videos. In fact, I find CRA's T2062 process runs more smoothly than the IRS counterpart, the Form T2062A, albeit the T2062 is more paperwork. But either way, here's the last and final step. Step 3, the concept of the gain and filing your Canadian tax return. Now, in the previous steps, I introduced the concept of the gain. Well, the gain is just your profit on the sale of the property. However, CRA has a different definition for the gain for the purposes of withholding tax than it does for the purposes of income tax. And the gross gain for the withholding tax is equal to 25% of what you sold the property for less your basis in the property. For the purposes of the withholding tax, you do not get credit for selling costs, real estate fees, lawyers' fees, etc. Okay? The following year, when you or I file your Canadian tax return, you can claim these expenses at the time you file and ergo pay tax on your net gain and then claim your refund. And if your ducks are all aligned and you followed my advice to a T, CRA is going to be real good at getting you that refund. Honestly, it's one of the things they do well. And that's it. Done and done. And now for some quick quirks on this process. I mentioned this in my previous videos on non-resident personal tax returns. When you receive rental income in Canada, you file it on a Section 216 return, and only rental income goes on a 216 return. If you happen to have also earned employment income in Canada, you would file a separate return known as a Section 115 return. Okay, here's where we try to confuse you. In my previous videos, I mentioned that when you receive rental income in Canada, you file a Section 216 return. On a Section 216 return, you report rental income and only rental income or rental loss. If, for example, you say you had employment income in Canada, that would actually get filed on a separate return known as a Section 115 return. So this is where things go really screwy. In the year you sell your rental property, you will file a Section 216 return reporting the rental income and the recapture, but you will also be filing a Section 115 return to report the capital gain. No accountants did not come up with this process. It just looks like we did. Finally, in these 4 videos, I have not included all the information relevant for owning, renting, and selling Canadian real estate. I've given you just enough information to get you started and get you thinking. There are a multitude of other issues, like I did not give you the list of all of the information that may be required with the Form T2062 and T2062A. In addition, there's other problems or issues that could come up. For example, what if an American dies while owning Canadian real estate? There are estate tax implications to this. Can you transfer the property to your spouse without incurring tax? Well, if you did it, you wouldn't incur tax in the US, but you would in Canada. So that's the rule, but in a nutshell, but never mind that for now. What about our treaty? Does it come into play in this particular transaction? Quite often it does. What if the property is owned through a corporation or partnership? More headaches, more work to do. Similar rules though. The list of headaches goes on from here. If you need more information, that is what I am here for. So to avoid an aneurysm, contact me at themactax.com. Again, you will get me directly, no middlemen. Or better yet, just click on the link below to get started. We can work all of it together. And thank you for watching this entire series. I'll see you on the next video. Take care until then.